One thing I see a lot is people getting frustrated with lenders. They'll say things to me like, I earn good money, Craig. Why is this lender being more awkward than that one? Or why will one bank lend, but another won't touch it? And usually that frustration comes from assuming that lenders are just being difficult, but they're not. They're managing responsibility. You see, lenders aren't lending their own money in the way that people imagine they are. They're lending money that belongs to savers, investors, pension funds, shareholders, people like you and me, and they're regulated very tightly around how that risk is managed. So, from their point of view, this isn't about being generous or strict. It's about making sure that the money they lend is likely to come back. And that's why risk matters so much. Every lender has its own risk model, and it's built around one simple question: what's the likelihood this loan causes us a problem in the future? Not today, not next month, but over the full life of the mortgage. Because if loans go wrong, it doesn't just hurt the borrower, it hurts depositors, investors, and ultimately the stability of the bank itself. And once you see it through that lens, the behavior starts to make a lot more sense. Lenders aren't just assessing your income, they're assessing stability, predictability, and behavior under pressure. Two people can earn the same amount, but one might be salaried, steady, and very predictable. The other might have bonuses, dividends, or variable income that moves around from year to year. It's the same headline income, but two very different risk profiles. And this is where people tend to get caught out. Let me give you a real world example, anonymized, but very typical. I worked with a client recently in a senior role, very strong earnings, very credible on paper. That client found a headline rate online that looked excellent and were understandably focused on that. But that lender wanted absolute income consistency and there was very little flexibility. The client, on the other hand, was likely to change roles within a couple of years and potentially restructure how they were paid. So, yes, they could just about squeeze into that cheapest deal. But if anything changed, they'd be stuck. So instead, we went with a lender that was slightly more expensive on the rate, but far more comfortable with variable income and future changes. Fast forward, the job change actually happened a lot earlier than expected. Because the mortgage was structured properly, there was no panic, there were no penalties, and there was no forced move. Everything still worked. On paper, that mortgage wasn't the cheapest. In reality, though, it was absolutely the right one. And this is the bit that most people don't realise. That cheaper rate you see advertised is usually designed to attract low risk, low maintenance cases. It's not a reward for being savvy, it's a pricing tool for predictability. So when somebody with a more complex profile chases it, friction appears. Not because they're a bad borrower, but because they don't fit neatly into that box. So what tends to happen is people take lender decisions personally, but they're not personal, they're mathematical, probabilities, stress testing, risk appetite. And once you understand that, you stop asking what's the cheapest rate and you start asking a much better question. Which lenders are comfortable with my kind of risk both now and later? Because the best mortgage isn't just about approval, it's about resilience. Options if you want to move, options if you want to borrow more money, options if life shifts slightly off plan. And that's why lender choice matters just as much, if not more so, than the rate. If you've just watched this after one of my rate videos, you'll see how closely the two link together. Cheap rates make sense once you understand the risk underneath them. There's another video on screen now about what I'd do if a fixed rate is ending in the next 12 to 18 months. That builds on this because lender behavior really does matter there. Now, as always, mortgage decisions should be based on advice tailored to your own circumstances. This is about understanding the system, not replacing that personal advice.